When I look at what's happening with government debt across advanced economies right now, the word that comes to my mind isn't crisis, it's transformation. And that should worry us more than any dramatic headline ever could. Let me start with something that might sound counterintuitive. We're living through what I believe is the most fundamental shift in how governments think about money since the abandonment of the gold standard. But unlike that dramatic moment in 1971 when Nixon closed the gold window, this change is happening so quietly, so gradually, that most people haven't even noticed it's occurring. The numbers alone tell a remarkable story. When I started studying economics in the 1970s, a government debt to GDP ratio above 60% was considered dangerous territory. Today, the United States sits at roughly 120% of GDP, Italy approaches 150%, and Japan, as I mentioned, exceeds 250%. Yet bond yields remain historically low. This isn't just unusual, it's unprecedented in peacetime economic history. Here's what I mean. For the past 15 years, ever since the Federal Reserve dropped interest rates to zero and started buying government bonds by the trillions, something extraordinary has happened. The normal relationship between borrowing and consequences has been suspended, not eliminated, mind you, suspended. And there's a crucial difference between those two things. Think about this for a moment. When you or I borrow money, we know we'll have to pay it back with interest. The more we borrow, the higher the interest rate becomes because lenders get nervous about our ability to repay. This is basic economics, the kind of supply and demand relationship that's supposed to govern all markets. But what happens when the largest borrower in any economy is also the entity that controls the interest rate? That's exactly the situation we find ourselves in today. The U.S. Treasury borrows money, and the Federal Reserve sets the rate at which that money is borrowed. The European Central Bank does the same thing for Eurozone governments. The Bank of Japan has been doing this for over 2 decades. We've created a system where the borrower and the lender are, in effect, the same institution. But there's another layer to this that's equally important. Financial markets themselves have fundamentally changed their behavior. Investment banks, pension funds, insurance companies, they've all restructured their business models around the assumption of central bank support. When was the last time you heard of a major financial institution seriously analyzing government credit risk? When was the last time sovereign debt traders worried about default probabilities for advanced economy bonds? This represents a profound shift in how capital markets function. Risk assessment, which is supposed to be the core function of financial markets, has been partially outsourced to central banks. The result is a system where price signals, the very mechanism that's supposed to guide economic decision making, become increasingly disconnected from underlying economic reality. Now, I want to be very careful here because this isn't some conspiracy theory. Everything that's happening is being done in broad daylight with extensive documentation and public debate among economists and policymakers. The question isn't whether this is happening, it is. The question is what it means for the long term stability of our economic system. Let me take you back to a period that might seem completely unrelated, but actually offers us a crucial parallel: the 1970s. Back then, we had a different kind of monetary revolution. Governments discovered that they could stimulate their economies by allowing inflation to run higher than expected. Workers and lenders, the thinking went, wouldn't immediately adjust their expectations, so there would be a temporary boost to growth and employment. At first, it worked beautifully. Unemployment fell, growth picked up, and politicians could point to tangible improvements in people's lives. But here's the thing about economic relationships: they adapt. By the mid 1970s, workers and lenders had figured out the game. They started demanding higher wages and higher interest rates to compensate for expected inflation. What had been a useful policy tool became a destructive spiral that nearly brought down the global economy. The parallel with today's debt revolution is striking. Just as the 1970s inflation strategy worked until people caught on, today's easy money policies work as long as bond markets remain convinced that central banks will always step in to buy government debt. But markets, like workers in the 1970s, eventually adapt to new realities. And here's where things get interesting. And by interesting, I mean potentially very dangerous. The scale of what we're dealing with today dwarfs anything we saw in the 1970s. U.S. government debt has roughly tripled as a percentage of GDP since 1980. European debt levels have followed a similar trajectory. Japanese government debt now exceeds 250% of GDP, a level that would have been considered impossible just a generation ago. But you know what's remarkable? Interest payments as a percentage of government budgets haven't exploded proportionally. In some cases, they've actually fallen. How is that possible? Because central banks have engineered a world where governments can borrow vast sums at artificially low interest rates. This creates what economists call a moral hazard problem. But I think that term understates what's really happening. When borrowing becomes essentially costless, the entire incentive structure of government finance changes. Why worry about efficiency when you can always borrow more? Why make hard choices about spending priorities when the money tap never runs dry? Let me give you a concrete example of how this plays out in practice. Infrastructure spending, something virtually every economist agrees is beneficial when done wisely, provides a perfect case study. In previous decades, governments had to be selective about infrastructure projects because borrowing capacity was limited. Projects had to meet rigorous cost benefit analyses. There was genuine competition for scarce funding. Today, across multiple advanced economies, we see infrastructure projects that would have been unthinkable in earlier eras, not because of their ambition, which is admirable, but because of their cost and timeline indiscipline. When money is free, project management becomes an afterthought. Why optimize when you can simply expand the budget? This isn't just about inefficiency, though. That's certainly part of the story. It's about what happens to the political economy when one of the fundamental constraints on government action, the need to balance spending against revenue, essentially disappears. And here's where the societal implications become truly profound. Democracy, at its core, is about making collective choices under conditions of scarcity. We debate tax levels, spending priorities, and policy trade offs precisely because resources are limited. But what happens to democratic deliberation when the scarcity constraint is removed, or at least appears to be removed? I've noticed something troubling in policy debates over the past decade. Increasingly, discussions about government programs focus on their desirability rather than their cost. Politicians promise benefits without explaining how they'll be funded, not because they're being dishonest, but because in a world of unlimited borrowing capacity, funding constraints seem abstract and distant. This creates what I think of as fiscal illusion on a societal scale. Citizens lose the connection between the services they receive and the taxes they pay, not because of accounting tricks, but because that connection has genuinely been severed by debt financing that appears costless. Think about what constraints traditionally forced democratic governments to make hard choices. They had to prioritize because resources were limited. They had to build coalitions because major spending required broad support. They had to maintain public trust because bond markets would punish governments that appeared fiscally irresponsible. But when bond markets are effectively neutered by central bank intervention, when borrowing costs remain low regardless of debt levels, these traditional constraints weaken dramatically. The result isn't necessarily more spending, though there is that. It's less thoughtful spending, less accountability, less pressure to demonstrate that public resources are being used effectively. Now, I can already hear the counter argument, and it's a reasonable one. Isn't this exactly what we want during economic emergencies? Shouldn't governments be able to respond quickly and decisively without worrying about bond vigilantes? Didn't this system prove its worth during the 2008 financial crisis and again during the COVID pandemic? The answer is yes, absolutely. In acute crises, the ability to mobilize resources quickly without being constrained by market pressures is enormously valuable. The problem is that what starts as emergency policy has a tendency to become normal policy. Emergency powers rarely get returned voluntarily. Consider Japan's experience, which offers perhaps the clearest window into where this path leads. Japan pioneered many of the monetary policies that other advanced economies adopted after 2008. For over 2 decades, the Bank of Japan has kept interest rates near zero and purchased government bonds on a massive scale. The results are mixed at best. Japanese government debt reached levels that should, according to traditional economic theory, have triggered a fiscal crisis years ago. But there's been no crisis. Japanese government bonds remain among the most sought after safe assets in the world. Inflation has stayed low, unemployment has remained manageable, and social stability has been maintained. But here's what's also true about Japan: economic dynamism has declined markedly. Productivity growth has stagnated. Innovation, while still present, occurs increasingly within a bubble of subsidized quasi zombie companies that survive because credit is cheap. The overall economy has become addicted to monetary accommodation in ways that make it extremely difficult to transition back to normal market conditions. Perhaps even more concerning is what this has done to intergenerational equity. When governments can borrow unlimited amounts at low interest rates, they face reduced pressure to invest in productivity enhancing infrastructure, education, or research that would benefit future generations. Instead, it becomes politically easier to maintain current consumption levels by borrowing against future tax revenues. This creates a peculiar form of intergenerational wealth transfer. Today's voters receive government services funded by borrowing, while tomorrow's voters will inherit both the debt and the responsibility for servicing it. In a world where borrowing constraints forced governments to be more selective about spending, there was at least some pressure to focus on investments that would generate future economic growth. When borrowing is essentially free, that pressure diminishes significantly. The housing market provides perhaps the most visible example of how this dynamic plays out. Central bank policies designed to stimulate economic growth have inadvertently created asset bubbles that make home ownership increasingly unattainable for younger generations. The same easy money policies that were supposed to help everyone have ended up creating a generational divide between asset owners and those trying to enter asset markets. And this brings us to the real question that keeps me awake at night: not whether this system will collapse tomorrow. It won't, but whether we're creating economic structures that become impossible to reform without triggering the very crisis we're trying to avoid. Let me explain what I mean with a thought experiment. Imagine that 5 years from now, central banks across advanced economies decide they need to normalize monetary policy. Interest rates need to rise, bond buying programs need to be wound down, and governments need to start paying market rates for their borrowing again. What would happen to government budgets when debt service costs double or triple overnight? What would happen to all those infrastructure projects, social programs, and policy commitments that were made under the assumption that money would always be cheap? What would happen to financial markets that have become accustomed to central bank intervention whenever things get bumpy? The honest answer is that nobody knows for sure, because we've never tried to unwind monetary accommodation on this scale before. But history suggests that when financial systems become dependent on artificial support, removing that support tends to be traumatic. This is why I think we're living through a quiet revolution rather than just an extended period of unconventional monetary policy. Revolutions, by definition, involve fundamental changes in how power operates. And make no mistake, the ability to create money is one of the most fundamental forms of power in any economic system. What we've done, without really meaning to, is merge fiscal and monetary policy in ways that make them nearly impossible to separate. When the central bank buys government bonds, is that monetary policy or fiscal policy? When interest rates are set with explicit consideration of government borrowing costs, who's really in charge, the Treasury or the central bank? These aren't just academic questions. They go to the heart of how democratic societies organize their economic affairs. Traditional economic theory assumes a separation between fiscal policy, which is democratically accountable, and monetary policy, which is technocratically managed. But that separation has become increasingly fictional. The international dimensions of this transformation add another layer of complexity. When the Federal Reserve engages in quantitative easing, it doesn't just affect U.S. markets. It sends waves of liquidity across the global financial system. Emerging market economies find themselves dealing with capital flows that have nothing to do with their own economic fundamentals and everything to do with advanced economy monetary policy. This creates a form of monetary imperialism, though that's probably too strong a term for what is largely an unintended consequence. When major central banks suppress interest rates, global capital seeks higher yields elsewhere, potentially creating instability in countries that had no voice in the monetary policy decisions driving those flows. The result is a world where monetary sovereignty becomes increasingly illusory for smaller economies. They can't effectively pursue independent monetary policies when their financial markets are overwhelmed by spillovers from advanced economy policy decisions. This forces them into uncomfortable choices: either accept financial instability or surrender even more policy autonomy by adopting capital controls or currency pegs. The result is a system that works remarkably well under current conditions, but may be extremely fragile to changes in those conditions. It's a bit like building a house that's perfectly stable as long as the wind never blows from a different direction. The problem is that wind direction always changes eventually. And here's what worries me most of all. The longer this system remains in place, the more difficult it becomes to imagine alternatives. A generation of policymakers is growing up who have never had to deal with genuine fiscal constraints. Financial markets are developing around the assumption that central bank intervention will always be available. Political systems are making commitments based on the belief that borrowing will always be cheap. If I'm right that this represents a fundamental transformation rather than just a temporary policy response, then we need to start thinking seriously about what it means for the long term health of our economic and political institutions. Not because crisis is imminent, it may not be, but because the changes we're living through may be more profound and irreversible than we realize. The debt revolution is quiet, but that doesn't mean it's not real. And quiet revolutions, in my experience, often turn out to be the most consequential ones of all. What happens next depends partly on forces beyond anyone's control: global economic conditions, geopolitical developments, technological changes. But it also depends on choices we make as societies about what kind of economic system we want to live with. Those choices are being made right now, whether we're paying attention or not. The question is whether we're making them consciously and deliberately with full awareness of their implications, or whether we're sleepwalking into a future that we haven't really thought through. Based on the level of public discussion about these issues, I'm not optimistic about which of those possibilities is more likely. But that's exactly why this conversation matters. Because the debt revolution may be quiet, but our response to it doesn't have to be.